If you've just inherited a home in California, you're probably bracing for a big tax bill. Here's the part nobody tells you up front. Most heirs owe little or even nothing if you understand one rule and you don't trip over it. I'm going to show you exactly which taxes apply, which ones don't, and the timing mistake that quietly costs families thousands. I'm Kathy Welmerling, a certified probate real estate specialist here in Orange County. I walk families through inherited home decisions every week, and taxes are the number one fear I hear. So let's take the fear out of it. The rule that changes everything: step up in basis. Let's start with the rule that does the heavy lifting, the step up in basis. Here, the simplest way I can explain: imagine your parents bought their home in 1985 for $100,000. Today, it's worth $900,000. That's $800,000 of growth. If your parents had sold it while living, they'd owe capital gains tax on most of that growth. But when you inherit it, the IRS hits a reset button. Your cost basis steps up to the home's value on the day they passed, $900,000. So that $800,000 in lifetime growth, for tax purposes, it disappears. You inherit the home as if you bought it today at today's value. Think of it like a car's odometer. Your parents drove that home's value up for 40 years. The day you inherit it, the odometer resets to zero. The tax man only ever counts the miles you put on it from here, not theirs. And California gives married couples an extra gift. Because we're a community property state, when one spouse passes, the whole home can step up, not just half. That's a huge advantage you don't get in most states. Capital gains, what you'd actually owe. Okay, so where does capital gains tax actually come in? Only on the growth after the date of death. Say the home was worth $900,000 the day you inherit it, and you sell a few months later for $910,000. Your taxable gain, it's that $10,000 sliver. After selling costs, often it's close to zero. Picture a flood line on a wall. The step up sets a fresh water line at the date of death. You're only ever taxed on the water that rises above that line. Sell while the water's right on the line and there's barely anything to tax. This is why timing matters so much. The longer you hold the home, the more it can appreciate above the step-up value. And that new growth is taxable. Sell near the date of death value and you capture the step-up at its best. That's the mistake I see most families sit on the house for 2 or 3 years. It climbs another $100,000, and now that's the real capital gains bill that the step-up would have erased if they had acted sooner. One more good news note: there is no California state inheritance tax and no state estate tax. And federal estate tax only touches estates in the multi-million-dollar range. So for the vast majority of families, it simply doesn't apply. Property tax and Prop 19 in 60 seconds. Now, the tax that surprises people. Property tax. Your parents may have had a low tax bill they held for decades. Since Proposition 19 passed, that low rate doesn't automatically pass to you anymore. The short version: to keep that low tax base, the child generally has to move in and make it their primary residence. And even then, there's a value cap. If you're going to rent it out or sell it, expect the property tax to be reassessed to current value. Prop 19 is big enough. I made separate videos on it. I'll link them in this description. For today, just know, don't assume the old tax bill comes with the house. A few cost people forget to plan for: insurance on a vacant home, which gets pricier the longer it sits empty. Ongoing property tax during probate, and any income tax if the property rents before you sell it. And here's a small step that protects you from a big headache. Get a proper date of death appraisal and keep it. The document what proves your stepped-up basis if the IRS ever asks. Don't rely on a rough guess. Get it in writing. Sell or hold from a tax liens. So, sell or hold from a pure tax standpoint, selling near the date of death usually captures the step up and it's strongest and keeps capital gains near zero. Holding can make sense, but go in knowing the new appreciation comes taxable and Prop 19 may raise your property tax. Every family situation is different, and that's exactly the conversation I love having. Your game plan, what to actually do. So let's turn all of that into a plan. Here's what I do in order. 1, lock in your proof. Get a written appraisal dated to the date of your loved one's pass and do it early. The step up saves you the money, but the appraisal is the receipt. That proves you earned it. No receipt, and years later, you're arguing with the IRS from memory. 2, respect the tax clock. If you're going to sell, selling near the date of death, value captures the step up at full strength. The step up is like a coupon. It's worth the most the day you get it, and it quietly loses value the longer it sits in a drawer. If you want to keep it, file fast. Planning to move in and hold that low property tax base under Prop 19? There are forms and deadlines. Miss the window and a benefit's gone. So loop into your CPA or attorney right away, not 6 months later. 4, get the family aligned early. If you inherited with siblings, decide together before emotions and dollars collide. A clean buyout or an agreed sale beats a court fight every single time, for your wallet and for the family. 5, build a small team, a probate savvy CPA and a probate savvy realtor. Talking before you list will save you far more than they cost. You wouldn't represent yourself in court. Don't navigate a 6-figure tax decision alone either. 7, quick tips. Before you go, here are quick ones I wish every family knew. Don't add your name to the deed before your parents pass to avoid probate. It feels small, it feels smart, but it can wipe out the step up and hand you a tax bill the inheritance route would have erased. Do keep every receipt. Selling costs, agent fees, and qualifying improvements all shrink whatever gain is left. Do call your insurance company the moment the home sits empty. A standard policy can lapse on a vacant house exactly when you need it most. Ask for a vacant home policy. Don't grab a fast lowball cash offer thinking you're dodging taxes. The step up already handled the taxes. That tax saving pitch is selling you something you already own. And do treat one clean, dated appraisal as your single source of truth. One document in writing beats 5 different guesses. So, if you've inherited a home in Orange County and you want a clear, no pressure plan, including how to time a sale around these taxes, that's what I do. Go to the links in the description and contact me. And remember, confirm the numbers with your CPA. But now you know the right questions to ask. If this helps, subscribe so the next family finds it too. I've got a video on Prop 19 right here. Watch it next.